death knell of September has passed. Last week we talked about it being a shitstorm for the Bears. This week, the VIX is in our face, getting to 20, saber rattling by every enemy of America. And we are here, special guest today, Jeff Macke, who looks great. San Diego, California living.
Thank you. And I'm a friend to America, Howard. I just want to go on the record right now and say that I am a friend to America.
You stand with Palantir, is what I think.
Can't tell you. I can't confirm or deny.
I got Jeff smiling right away. All right, so Jeff, you are a local with me, San Diego.
Yep.
Free and unbounded by gates. You are living the good life in California near the beach. You look great. What are you clocking in at right now at age? What's your age?
I'm double nickels, baby. 55. 55. So I'm Gen X. I'm not a boomer like you. I'm right on the cusp.
I feel it's important to ask them at 55, have you peed before the show? Because this sometimes goes on a little bit.
Several times. Like every 3-4 hours, whether I need to or not. That's just a thing that happens. There's no dignity in old age, and it's fine. It's fine. It doesn't mean I'm not healthy. It's just a normal thing.
Yeah. The only person in this group that may not get up is JC. So just be prepared that Michael may disappear at any moment. Phil may do a push-up and eat some eggs.
I just did a good number one right now before the show. Don't worry.
And JC may disappear for some Prosecco. But welcome, Jeff Macke. We've known him for 100 years and always has different takes than the rest of us. He's a trend man just like ourselves, but thinks about the market differently. Joining us always to talk about the biggest trend right now. Also, he's been a guest now, I don't know, 20 weeks in a row. Michael Perek, the AI whisperer. A really good contraction to Jeff's Mark Andreessen look. Michael, you got a haircut. You look very clean. Oh, Michael's sound is off, I think. And there's some digging going on. I think they're getting into a tunnel. Or is it me that people can't hear?
I can hear you.
Clear, Linzone.
Okay, so it's Michael's sound is off. And then joining us also, as always, JC Peretz, freshly gelled. Can you rest your coffee on your head for us?
I actually have pretty good balance. I was a pitcher many years ago, so they would make us stand on one leg for like 10 minutes at a time and shit. It was wild.
Well, you are looking coiffed and perfect. And then just getting out of bed wearing an undershirt, the size small. Phil Perlman joining us from his basement. Trends with friends as always. So here we go. We've got Mike just dropped off. He'll be back. So Phil, take it away. What do we want to cover today? Let's keep it going. Now Phil has got no say.
Everyone's muted.
I know. I was on mute. I just wanted to make sure that it was not me moaning in the background, whatever that is.
Can you all hear me now?
We're going to get right into it. We're going to talk about China, and China's going crazy. We have some China monthlies. Oh, by the way, today is the first of the month, and so beautifully, we have all these fresh monthly charts. JC is the master of the monthly charts, and Jeff, by the way, just I love you, dude. Great to see you. We're going to have a lot of fun today. We're going to talk retail into Christmas. We have photos of you wearing masks and dressed up for Christmas. It's all great. Okay, so let's get right into China. FXI monthly. I don't even know what's going on. They're just dropping. They're dropping yuan. Is that how you say it? They're dropping the yuan out of fucking helicopters everywhere you look. It's just money, pennies from heaven, as they say. And so over the last 2 weeks, we're seeing China large cap, all these different stocks, the YOLOs, the Degens, the Cha-Chas, all going crazy. JC, what's going on right here? It's a monthly, 18-month high. What's happening? It's a hell of a candle right here.
Yeah. I mean, listen, in bull markets, stocks go up. And what tends to happen is that the laggards in those bull markets tend to catch up to the leaders, right? That's that sector rotation that you see in all bull markets. In bear markets, it's the opposite. It's those final remaining leaders that catch down to the laggards that are dragging down the overall market. So China is really just next. It was one of the most crowded trades in the world, according to Bank of America's fund manager survey. So this is a short squeeze is really what you're seeing. The bull market, emerging markets, just in general have been doing really well. Emerging market currencies have been ripping since the summer. So there's a lot of things pointing to rotation into China, but I don't care who you were, to see something like this is epic. You know, we talk about momentum thrusts, we talk about breadth thrusts, initiation thrusts, like all those words that you hear, this is all of them, right? Like, you know, when people talk about, you know, the efficient market hypothesis and how, you know, markets are random and all that stuff, like, you know, how many sigmas was this? This was all the sigmas, all the sigmas. There were so many sigmas. There are markets that trend, and there are inefficiencies to take advantage of the market, and this is one of them. And when you look back in history, you ask yourself, okay, are these sorts of market behavior patterns something you tend to see towards the end of cycles, or is it very consistently at the beginning of cycles? And you'll find that these sorts of things happen at the beginning, not at the end. So further evidence that, you know, I think the bull market for equities, not just in America, but on Earth, has legs, particularly if something like China is just starting to get going, making new 18-month highs. And if you go to the next chart, you could see those momentum thrusts absolutely ripping. One-day rate of changes. This is Tel Aviv, but no, the one-day rate of change, the Shanghai Composite relative to the Nikkei, I think is just, you know, when you're wondering where's this money coming from, you know, the Nikkei has gone nowhere in Japan for several months, and China's really getting going. There you go.
Perfect. Let me ask you this, Jeff. Do you have a take here on China, given your knowledge of the retail market and, you know, the way that they export to the U.S. and the beginning of Q4 and so forth?
You know, I'm happy to hear JC say that about the this being more of a kind of mid-game move in the bull. It's what switched the fastest was just there's so many reasons to hate the Chinese stocks, right? It's and just a litany. Man, the accounting is crap. You don't know what you're buying. They're going to screw you in the end. I don't want any piece of it. That immediately became, holy shit, I needed to own BABA, and I don't really care where it's trading because I need a proxy for this right this second. And you know, there's a lot of things playing to that. Right now, you got to tie it into the longshoreman strike, right? You got the longshoremen on the East Coast. They're threatening to shut down everything in the Gulf. That's like 60%, give or take, of what the U.S. takes in. China is the exact opposite. China right now gives all the signals of just a region that would like to ship us a whole bunch of electronics in one big pile in one big huge hurry. You got 80% capacity in the LA port. And you also have the fact that we just went through the pandemic, and holy crap, if you haven't figured out your distribution by now, if you're a retailer or merchant, you're kind of screwed anyway. So, you know, I'm looking specifically like at just contrasting kind of the Best Buys, which obviously takes in most of their stuff from China. They're not going to be impacted by this Christmas, versus say a Birkenstock, versus say, you know, it's these companies that are bringing in goods from primarily Europe. And that's really where you're going to see the rub. But I think that this is going to be kind of transitional. You know, I feel like they're going to pick up the slack, and that should minimize sort of what we have going on the East Coast kind of tensions right now. That doesn't mean it can't become a stock market MacGuffin. You know, the last 2 months have both started, they just kind of took a crap the bed for the first 4 or 5 days, like down 4%, 5%. Those sell-offs got immediately bought. You know, we're kind of setting up that way again. You got a lot of bad news. It's October 1st. We're supposed to be afraid of October. We've got the election coming up. You know, in bull markets, that stuff gets bought. That's what we've seen the last 2 months. So I'm not sure how much people want to get short it right now, but man, you can't ignore China. You absolutely cannot ignore the price action. You can't ignore kind of the amount of money that's flooding into it and the impact that's going to spread throughout.
Michael.
And I'll just add to Jeff's excellent points on the retail side. Remember, and we've talked about this in previous shows, China is also totally ready to ramp on automobiles, just much more big ticket items. They have extraordinary amount of surplus capacity, the great products, amazing prices, etc. And it's an opportunity, I think, from a regulatory point of view. And I know the US is going through a major election.
whatever comes out on the other side, there is an amazing opportunity, especially in the US, where there's a focus on getting rates down with the Fed's beginning of the moves. If the goal of the developed countries is to have lower interest rates, better inflation, etc., it behooves us to have some form of globalization resuscitated. So we need to thread the needle with China. We need to thread the needle with the China. Yes, mind the geopolitical issues that we are careful about, but there is so much opportunity in terms of so many inputs that we, as the biggest economy, need to make goods and services. We can still be above them. And I pointed out on technology, Jensen was, NVIDIA's founder CEO was in DC this week. And this is the message he was trying to tell the policymakers that, hey guys, our bread is buttered on both sides. We need China and all their related companies as a market. We can manage without them, but it behooves us to thread the needle so that we can avail ourselves of their production capabilities, etc., and build be the leading AI company in the world. With AI products and services, we can do both things. They sound like opposite things. I had a post up on this. Two opposing ideas can be true at the same time, and we can thread the needle here. So I want to point out, on a fundamental basis, China is an opportunity, not a threat. Still.
Yeah. Listen, this is called Trends with Friends, and the first rule of China is once you buy one Chinese stock, 20 minutes later, you're hungry for another one. So let me just put that out there. Which buying begets buying. Second thing is, we're all friends. They are not our friend. Okay. In terms of, I don't know how, and listen, thank God I'm not running for office, but if I was running for office, I would be horse trading. Hey, take your TikTok back. We'll cut the tariffs on other things, right? They're flooding our country with vapes. Those vapes are cats and dogs are now addicted to smoking. So China's playing a different game politically than us. And like we talked about last week, there's no sellers left of Chinese stocks. So part of this is the fact that Z probably and the insiders own as much of Alibaba and Tencent as they could buy the last 3-4 years. If you look at any Chinese internet stock, okay, American internet stocks are hitting all-time highs. Chinese internet stocks were the 1999 NASDAQ. Every Chinese stock from fintech to Alibaba was down 80 to 90% during an internet and technology revolution. So, even as Jeff and I know, even though these are fake financial products in terms of where they structured, and you think you own Baba, but what offshore entity do you really own? So you're really buying a proxy. It's just a trust game. The fact is, they had a 1999 type pullback in a U.S. bull market. So this will probably go on forever, but like you got to respect the fact that rug pulls is their middle name. It's a country of fraud. It's a country of cutting corners. It's a country of where gray means go. But at the same time, the money flow, as JC shows, is what drives all this. And if money's flowing in, doesn't matter really what the fundamentals are. All right, so that's China.
JC, do we know anything about the historical price data related to a recovery in China and U.S. markets?
I mean, listen, I always like to preach that, we're earthlings. We're not just Americans when it comes to the market, and having Chinese equities going up in price and returning investors value is not a bad thing for the stock market and stock market investors overall. So if you have no interest in China, if you hate China, if you're never going to buy a Chinese stock ever, you're still rooting for Chinese stocks, right? Like I'm rooting for Chinese stocks. I mean, I own some Chinese stocks, but even if I didn't, I own American stocks. And it's not a bad thing for American stocks if Chinese stocks are doing well. Think about the composition. Also, as I might add, I could bring up the chart, but historically, China has a very strong positive correlation with base metals and copper and things of that nature. And for us historians, today's China is not, your father's China, where there was a lot more exposure to natural resources. A couple decades ago, China was a commodities play, right? And what's interesting is that the composition is very different today than it was then. However, the relationship with base metals and copper remains very much in place. So I wanted to throw that out there as part of the implications of a strong Chinese stock market.
I'll just add
Michael,
one more
last
thing.
comment.
Yeah, just
we'll
last
move on.
comment on commodities. The U.S., because we talked about the longshoreman strike, we had just Helene just taking out so much damage in the U.S. on the East Coast. North Carolina, unknown fact, spruce pine, you can Google it. It's one of the biggest sources of silicon in the United States. It's basically the purest of the silicon that we need to build chips. So, and it just got taken out in this flood. And no one knows the damage of this and what impact it has on the supply chain of chips, our independence versus China, etc. But some of the other big sources of silica, pure silica, in terms of commodities, China. And so I just want to point out the world is very interconnected. I love the quote, we are, earthlings before we are from this place or the other place. Our ecosystem depends on this. Apple, the majority of the production, 80% of the production of all the gizmos that they're selling, $400 billion of smartphones for the industry, most of that stuff still is built in China. We have to figure out how to be their enemy and their friend. So, and the supply chains are very, very intertwined, very important to keep a track of. And if we don't, prices are going to go up, and we're going to be talking about VIX at 60 again.
And this is what I said, Mike. We need strong leadership that says, hey, you got a digital wall. Welcome to our digital wall. Okay? We don't want to do this. You started this digital war. So we can have two things can be true. We can kick out TikTok and we can kick out Chinese vapes, but we can do business together. Okay? Like that
Correct.
is, I think 90% of people could agree on that. But anyways, all right. So I think what JC says is true. Price overrides all this stuff. And as Helene Meisler says, who I love dearly and is just so funny on Twitter, there's nothing like price to change sentiment. And so whether you like it or not, prices change sentiment. All right, Phil, next.
Okay, so now we're going to go to Jeff, and we just call him Lean Santa because he's such an expert. He's a healthy Santa. He's a metabolically healthy Santa, Lean Santa. That's his own little image that he created. It's a self-portrait. Like Van Gogh does the self-portrait with the bandage on the ear. He does the self-portrait with the Santa hat. It's like my favorite thing. And we're going to talk retail going in. It's perfect timing to have him on because it's October. We're heading into the Christmas season. What does he love? The first one, let's go to Dave & Buster's. And Howard, this one's a special just for you because it's a degen play. Like Jeff just calls this a degen play, and it's totally right. Jeff, what's going on here with the chart and also with your fundamental outlook heading into Christmas on Dave & Buster's play? Perfect ticker. You're on the mute.
Am I back on? Can we hear me? Can we hear me?
There you go. Everybody's on mute.
This is technology, people. It's fantastic. Hey, listen, the degen play here is these are basically sports bars and arcades. They've been given up for dead. This company, you probably haven't heard of it in years just because it was kind of just a restaurant tacked onto the mall. You've got new management in there, but what you mostly have is a really cheap company with a lot of different ways to win. That they're improving their margins, they're doing a rehab of their stores, and they're trading at 5 times EBITDA, which gets you into like Top Golf territory. Linz and you probably are familiar with the Top Golf story. There's not a lot of good things happening there. Dave & Buster's is doing much better, and mostly it's just a sports bar. I've actually been going to a few of them. I'm happy I'm still Lean Santa because it's not the friend of leanness at Dave & Buster's. But they're picking up traffic without the malls picking up, which is interesting to me because they're becoming their own destination. So they're getting huge deals from the mall operators, and they're able to expand these new store models and increase kind of their flow. At the same time, their food and beverage margins are going up. Their stock is still ridiculously cheap. You've got great support at that 30 area. They've got decent cash flows, which gives them a lot of things they can do with it. Right now, they're remodeling their stores for the first time since 2017, 18. About 10, 15% done with those. That's going to improve their comps. it just gives you a lot of ways to win. This company, if they improve their comps by even a little bit, you're looking at $60. And it's forgotten, it's unloved, and it's not, obviously a momentum stock, which is great right here because we're a little late in the rally on some of these consumer plays.
Jeff, you had me at 5 times EBITDA. That's
right.
It's no, I don't know this as well, but I know the experience space, etc. And this looks, it's 1.3 billion market cap. It feels like sports bars are our generation's bowling alleys. This looks like something worth kicking the tires on.
But what's the cat? I mean, that's a trends with friends.
1.3 billion.
No, what's the catalyst here? So,
Your catalyst, new management.
So do I have to like China own this, and then the move happens, or do I wait until, if this can be a $5 billion company, why not wait till it's $2 billion?
This is a little bit part of kind of the other themes I've got going on are what we've seen, and JC can speak to it as well. Companies are not going down on the bad news anymore. You're seeing kind of basing action going on in your Home Depots of the world. That's almost at a new all-time high. No one has liked Home Depot for a zillion in 5 years. Best Buy is another one of my picks right now, where everybody's shooting for them to go negative comps. Like there's the Home Depot chart. They reported they took numbers down in August, and the stock actually rallied. The stock is higher since then. So they kind of stuck it to every single person who was just sort of lazily short this Home Depot on the idea no one's ever going to remodel their house again. You saw the same thing in Restoration Hardware. The reason you don't wait necessarily, Howard, is that by the time you see these things start to turn, you kind of have to know the management. You kind of have to go out to the stores, to be honest. And that's going to be your catalyst on Dave & Buster's. They get huge margins on their food and beverage. They've completely revamped their menus. I like the management team there, gotten to know them a little bit, gotten to know other shareholders who are active in it. And I feel like the risk reward is set up pretty well for them. They're not going to get much cheaper. It's believe me, they've had a lot of bad news to test that 30 level on that stock. And, it's if they were going to tank below that on anything that wasn't just kind of apocalyptic, you would have seen it by now. They're getting in traffic where you wouldn't expect them to see it. And also, again, it's with the sports gambling, with the amount of ways that you have to kind of channel sports 7 days a week now, their traffic is really picking up, and they're really playing into that in a way that's kind of creative and cool. And, it's just got a lot going on for a company this cheap.
Howard, if you want the catalyst for Dave & Buster's, 30% of the float is short in the middle of a bull market as consumer discretionary is getting rotated into.
Yeah, it's a vicious 2024. I haven't been in Dave & Buster's. I'll ping my son. But this is why we have guys like Jeff on, right? We can't just blather about.
Trust me, no one wants to go to Dave & Buster's. It takes a certain sacrifice of your pride there, but you go in there and again, you hang out. I'm looking for kind of happy hour rush. I'm going into a dead mall where you see you could play golf in these malls without hitting anybody with a ball. You could honestly just make a little par 3 and smash it down the middle of these malls.
I'm good at the throwing of the things, like throwing footballs and baseballs. I get all the tickets. It's fantastic. My kids think I'm a hero.
It is. I was there. It was honestly just an ad for Dave & Buster's, both in good and bad. You got the parents that are doing some interesting parenting, which is we're going to watch the Dodgers game, and why don't you just go play with the tokens for a little while and do the shoot 'em up games? That's fantastic. I don't know. I'm not there to judge their parenting, Howard. I'm there to kind of look at the investment in the stock, and if they're able to pick up some decent chicken tenders and send their kids off for a couple hours to play the games. But yeah, to old people, young people, guys like JC throwing the plastic axes, they've got remodels in effect right now. They're a little bit slow. I like them so far. I want to see them roll out a little bit, but that's going to be something that they're going to accelerate that over the next 6 months, and it's going to work before that. If it works at all, and I think it will.
And looks like
and
I'm friends with the Bolero team, which has done well through a SPAC, and so I think there's also acquisition potential. Okay, very different idea.
And you got to love the ticker play. I mean, if that's not a meme stock ticker, I don't know what is.
And JC, do you have to? You have not. I was looking at your chart that you just posted, and you have defined risk there as well. Is that correct?
Listen, I think there's a bigger story going on, which I'm super thrilled that Mackey's here, because I really wanted to ask you this question, because I feel like I'm just looping. I'm just talking to myself about this rotation into consumer discretionary. If you could scroll down here to slide 15 on there and show Jeff this chart, This to me is the bigger thing. Phil's right. There's well-defined support. I love how Mackey called that out. Some things never change with you, Jeff. I love you for it. You know, huge short interest. I love the discretionary space in particular. The question that I posed to my team, to our investors, to myself this summer was very simple. Is this a massive decade-long top in consumer discretionary on a relative basis? Because if it is, bull market over. So if you think that the bull market is over, then you're looking for this to complete. I was not convinced this summer that bull market is over. Quite the opposite. So if you reverse engineer what a bull market looks like over the next 6, 12, 18 months, it's consumer discretionary, money rotating back into that, which is why we've been buying Tesla so aggressively, why I like this breakout in Amazon, why I think Home Depot, I'm glad that you brought that up. These are the three largest components in consumer discretionary. Discretionary was one of the leaders in Q3. Discretionary up double digits in Q3. Tech was flat in Q3. So this rotation, I think, is real. It's part of this high beta rotation that we're seeing. China is one of those. I think discretionary, you're seeing in a lot of these beat up areas that have been left for dead. So Mackey, any thoughts on all that rotation?
I completely agree. I would add to that you can look at it a little bit as a stock picking factor, and as well as this point and the other side of the pandemic. You look at something like Dick's versus ASO, two sporting goods stores. They should have a huge overlap. Dick's has just taken them to the woodshed. And they've done that because, just like Best Buy, they've redefined themselves over the last 3-4 years. They figured out how to be a store that's going to be online and offline. So you go to a Best Buy now, the experience has totally changed. But that's in a great way. Corey Berry, the CEO there, has done a great job.
Yeah, but Jeff, isn't that perfectly normal for this space, that you know better than anybody else in this world, that for every Texas Roadhouse, you have a Denny's. For every Wingstop, you've got Wendy's, right? Like, you know, the dispersion between the winners and the losers and these consumer brands, hasn't it always been super wide, you know?
Oh yeah. Oh, absolutely. Yep. Absolutely fair point. And that's why the indexes generally tend to work, because someone's going to fill in that void. Amazon's taken a lot of share. Right. Dick's is more than made up for the ASOs of the world, but they've rolled up everybody. And in that particular Dick's Sporting Goods case, they've taken over golf. They had Golf Galaxy, which they wrote down to almost nothing. Now that turns out to be a pretty good business because they're doing fittings again. You're always going to have winners and losers and people taking share. You got to worry about the Chinese factor in some of this stuff. It's a little bit overstated in terms of how much of a risk that is. The appetites, as you can see with like the Five Belows of the world, the appetite for super cheap shit is not necessarily there anymore. I think we're just getting to the point where we're normalizing post-pandemic, and you're going to see people kind of restocking up. They're going to get new TVs again. We're going to start redoing our house again. It's been 3-4 years since we all started nesting. And so at this point, there's a little room in the discretionary world. And so you're seeing kind of the better names, the Williams, the Sonomas of the world. They're going to be taking share from the resto. And you're right. And then those two just kind of balance each other out. And it's like, you end up with a decent housing, between the two of them, you got winners and losers. But yeah, I feel like discretionary has been hated long enough. I feel like they've been punished long enough. People need new clothes eventually. And, you're seeing a lot of winners. Nike is another name that I like right now, but they spent the last 3 years just getting kicked in the ass by the OnClouds, by the Hokas, just giving away share in this monumental future business school case study way. That's going to reverse over time. That's they bought themselves a couple quarters with the new CEO coming in. It would have been better if it was a new CEO as opposed to an old guy. But that's kind of a baby Starbucks turnaround type of play idea, and it's going to be just a matter of them getting back market share. But it's how bad is the consumer really if they're buying OnClouds for $180 just to walk around in them?
Well, that's a good point. And I hate the shoe. I've tried the shoe. I don't like the shoe. I'm still a Nike guy. So all good points. What do we got next, Phil?
Let's take another look at that Home Depot. We mentioned it very briefly. Jeff, you talk, but let's show JC's chart because he backs it. We showed Jeff's chart. It had that rounding pattern, but now let's look at JC's because he backs up the lens on that. And we see how that may be consolidation, which within this gigantuan bullish move over years. And it's a great day because it's a monthly chart and the monthlies just came out today. So you could see this incredible move and then this huge bull. And now we're coming right back up to the high from late 21 or early 22, whenever that was. And so, Jeff, tell us a little bit about your fundamental case going into Christmas on Home Depot.
I think Christmas is, generally speaking, going to be better than people expect. I think that you're already seeing. You look at Target, you walk around your neighborhood. Look at the spending forecast that came out, all of which you take with a grain of salt, but you add it up, and it's just like when I see JC and I both did the little cup there. That's beautiful, man. That's purely coincidental, but man, when your anecdotal and your charts and all this stuff starts lining up together and it all kind of agrees with each other, that feels pretty good. That feels pretty right. And so Home Depot's they're ahead of where their fundamentals should be. But again, this is the market telling you that they're betting on a turnaround in this space, and they're doing it now. They're not waiting for this to happen. They're not waiting for Home Depot's comps to turn. So this is a company that's posting negative comps. They're taking down guidance, and the street's just saying, you know what, screw it. I'm buying the stock anyway. You can't ignore that kind of price action. Home Depot is still a really well-run company. And again, we're 4 years post the pandemic kind of peak. Everybody's nesting. Everybody's bought the next 10 years worth of house. It's eventually you need a new couch. Eventually you need to kind of fix the rec room again because stuff starts to get a little dated. The economy's not that bad, and we're entering that cycle. And so as we go into the holidays, a 7% report, it's these estimates are always kind of crap, and they always want to make it look like the biggest Christmas ever. But that was just one of the the forecast coming out that came out this morning or last night. But 7%'s a huge gain. That's past inflation. That's past anything you could be forecasting. That's the expectation for holiday sales gains. A lot of that's going to go to home decorations. It's going to go to stuff that is both permanent and fleeting. But it's already happening. Halloween is essentially already part of Christmas at this point. And returning to the ports, 80% of the goods that are going to come in for the holidays are already here. So it's the dock workers can talk about how they're going to shit all over Christmas and it's going to be just the apocalyptic nightmare. That's not going to happen. And so I love this weakness as we start the month as a chance to kind of enter into some of these positions that that HD looks a little extended right now. Take a little break, get a little long, and I think it's going to pay off.
Have you found historically that these type of stories, I mean, this is not your first rodeo. You've been around. For people watching who are not familiar with these types of strikes and when they happen and how they play out, these are, in your estimation, temporary phenomena that you can utilize to get the positions you want at better prices potentially. Is that what you're saying?
There's absolutely no question that the longer this goes, the worse it is. I mean, it's let's not kid ourselves. And it's politically fraught, but there's absolutely no side of the table that wants higher prices in the immediate future. And if you're going to let bananas just rot off the coast, you're going to have higher prices in the stores. It's not going to be gouging. It's not going to be anyone's fault on the political side. It's going to be a bunch of longshoremen. But I would be much more worried about this if we didn't go through just the supply chain disruption of all time. Like 4 years ago, 5 years ago, people were American Eagle Outfitters was going into the shipping business. They were subletting space on cargo containers. American Eagle Outfitters is not that kind of company. So that was kind of peak distribution in terms of snafus, in terms of problems. So you can look at it two different ways. One, which of these companies, which of these retailers are taking more stuff from Asia than they are from Europe? And that's what brings me back to kind of the Birkenstocks, the ASOs versus the Dicks, the Best Buy coming in. It's taking most of the stuff from China. They're less at risk, but I don't think the risk is going to be coming in until probably first quarter. You might hear some snags going on in the Christmas season. There might be some problems from reorders, but it's October 1st, man. People are shopping earlier than ever. More than half of the country's already bought Halloween stuff, or at least started to. They've done so in September. They're already starting Christmas shopping. So this is not going to be kind of something that we have to worry about. Now, the longshoremen are going to argue otherwise. And again, we don't want this going on for 3-4 weeks. But to the extent that it does go on, I want to be buying that dip because, I like my bullish catalyst to be out there. I love the Meta goggles coming out in the future for Best Buy, because that means that they're not going to miss deliveries on the first quarter. They're going to, it's something we can just talk about. AI is coming out. It's going to be here at some point. At some point, people are going to be buying their TVs. I want to be long in front of that. I don't want to be long, when it finally hits the shelves. By the time that happens and you got the mania and the frenzy, the way you used to get with Apple, the stock would ramp 15% into every new phone release, and then it would sell off immediately afterwards. Right now, you have the opposite going on, where people are so hateful of it, they don't think anyone's going to buy a new TV again. And I just bought new TVs. I can tell you right now, it's a better service operator. Best Buy is just a better place to shop now than it was 3-4 years ago. It's a better store. I'm willing to pay more for that. And as it happens, I get to pay less.
Super.
Hey, JC,
Phil,
if I know you, you're waiting for. Go ahead. Sorry, Howard.
Let's flip to like what's else happening in the market, and then get to AI quickly with Mike.
Yeah, let's go right to the AI. It's such an interesting topic. We have these nuclear plays. So AI is going nuclear. And so here's the thing. Everybody's talking about it. Everybody's talking about the Microsoft thing with the 3 Mile Island. But Michael, there are investable plays out there. There's ways that we can express this with our risk, with our money. So why don't you just tell a little bit about what's going on, and then we'll get into what we can be doing here, ways we can be playing it. That's not the chart we want to be showing. That's a one-day chart. We want to show those 1-year charts that I sent over to you. Go ahead, Michael.
Yeah, the broad picture is that, look, we've known about the AI data center wave. Jensen's been talking about it for at least a couple of years. Microsoft, Google, Meta, they're all buying every chip that we can get our hands on. We're going from these companies buying hundreds of thousands of chips at $30,000 per chip, to millions of chips. But they need to be in massive data centers, not just one, but dozens across the country. They're all connected by fiber. But guess what they need? They need massive amounts of power. So the power story, it's like a sleepy store that grows at 2% a year in sales, and now all of a sudden 3 or 4 customers come in and basically say, we're going to buy everything in your store today and for the next 3 years, everything. And that's what's happening in the utility power business. And nuclear, which was on its hind legs, on its death rate, because for 50 years we've been worried about nuclear risks, that after 3 Mile Island in the 70s, we shut down innovation. In fact, we don't barely make any nuclear. All our nuclear plant companies are now overseas, and the leaders today are China, what we were talking about. China is about to build 20 plants in the next 10 years. We're lucky if we're going to build 1 or 2. We have 94 nuclear plants that are 30, 40, 50 years old. And what's happening now is Microsoft, Google, Meta, Amazon, they're all rushing into these stores and saying, we're buying all your capacity. If you got this thing shut down, we will turn it on. We'll give you $2 billion, $3 billion to turn it on. And that's what's going on. Microsoft came and said we will give you $1.6 billion to turn on the one of the 3 plants at 3 Mile Island that could be turned on. It'll take 2 or 3 years. We'll pay the money, but we want to put data centers right next to it, because guess what? We're going from 50, 100 megawatt data centers to a gigawatt and higher data center. Those are amounts of energy that power entire cities and towns, millions of customers. And so you've got a huge bull in a china shop, literally. And that's what's going on. And the utility industry broadly, and the nuclear industry is all of a sudden in the last 6 months has woken up and said, holy moly, we need to figure out how to do this. It needs huge amount of regulatory help. So state governors in Pennsylvania, in California are now being forced to think about, hey, do we recommission plants that we had decommissioned for safety reasons? They're doing that, but it's a slow process, Howard. And the point is, the pressure is happening much faster, because these companies are coming in with literally multi-billion-dollar checks. That's what Amazon did in Pennsylvania with Talon that you had up on the chart. They're buying up at least half the capacity of the nuclear plant that was in Pennsylvania that they're going to build 2 or 3 centers, and they probably want to buy the entire thing. I had a couple of big posts on this in Ohio. They're basically, there's regulatory tussles going on where the utility commissions and the companies are saying, hey, if you want to buy up half our capacity over the next 10 years, then you need to give us even more guarantees. So there's all these pricing things that are going on. But we are in a world where the amount of energy that we're going to need for data centers is triple or quadruple the amount of supply that can realistically be put on. That's why we're going into our cupboard and taking off the shelf decommissioned nuclear plants and trying to turn them on, even though they're going to take billions to turn on, billions to 3-4 years to turn on. But that's the clip at which these companies are investing, these $50-100 billion.
I mean, if you look at the money flows, it's why CCJ and all these uranium stocks, not to be cynical, but Nancy Pelosi was probably long a lot of these. Anybody in the know, it's hard because I don't follow this sector and I don't understand what's underneath them. But CCJ, Camco, and NXC, these stocks were ballistic ahead of kind of the policy that we're now talking about. So the question is, what works because of this? I think if we're really serious about nuclear, it's another reason why interest rates are going to be coming down, which will lead to all kinds of unintended consequences, which leads to consumer discretionary, right, and mortgages and Home Depots. So everybody's talking about AI, but the real big play in AI may still be energy that's needed. And
no, it's
a good subject to be chatting about.
No, it's very analogous to the internet wave. I was the head of Goldman Internet Research. Mark Andreessen just had a post that there was no internet bubble. He actually had a post that said it was not a tech bubble, it was a telecom bubble. And he, it's a smart way to kind of reframe it, because he said that, the industry in the 90s, from 95 to 2005, spend $1 trillion basically building up the telecom infrastructure so that we can 10-15 years have broadband. That's what's going on right now. The industry, the utility and nuclear, et cetera, is being raced ahead. We're going to spend probably $1 trillion. Goldman just had a report that said it's going to be $2 trillion market for cloud computing. And so all of that needs power. The only way to scale up major power is the nuclear plants, is one of the ways. And the other way is to go to the Middle East and build, dozens of data centers there. But guess what? Then we're in the Middle East and we're kind of stuck there. We don't want to do that. So we need the energy here. The biggest, and we are the biggest oil gas producer on the planet today. And we have a neighbor, Canada, that has a huge amount of power and water as well. So those are the two places, if we want it close to home, are we going to have to go? And nuclear is one of the faster ways to do this. And I'll just point out one more thing. One of the biggest capabilities America has that almost no country has is our Navy. Our Navy has almost 95, 100 what are called modular nuclear reactors on ships and submarines. And no country has that. And we've operated those for 50, 60 years safely. And there's a huge opportunity before we get to fusion nuclear reactors, SMR nuclear. These are all the next generation nuclear technologies. We have a huge amount of capacity. We just need the political and economic will to take some of that stuff and apply it for data centers and so on. So besides these companies that we are going to talk about that have already run up 50, 100, 150%, there's a big amount of secular play on energy in nuclear to come in the next 3, 4, 5 years, because you're going to have just a lot of need for, and it's a supply constrained market on power for at least 3 to 5 years because of what AI is about to do.
JC,
this goes to the just quickly. I will go to Jason. This goes to the problem with mobile investing. Like it's a perfect storm in the sense that this last generation of investors has been trained to index, and there's definitely nothing wrong with that. I do that. They have a small Robinhood screen that has 8 stocks on it. They don't know how to build watch lists. They don't know how money flows. We're seeing it in the venture capital market, where these kids that got into venture in 2016 are completely upside down. And so there continues to be this misallocation of capital, because you pulled up the Constellation Energy ticker, I fucking just finally followed it. There's only 2,400 people following Constellation Energy. And it's a $80 billion market cap, up 400% the last year. So the market continues to do its magic of rising in places that people don't own the stock. And
Totally.
and while I agree with you on consumer discretionary, JC, because you're right, it's confusing because there's such a dispersion of winners versus losers, and we spend so much time talking about the Teslas and Nvidias, which have Tesla's probably the best stock of all time until the last 3 or 4 years, and then Nvidia's been the best stock of the last 3 years. But behind this have been some incredibly underfollowed trends, and that's just part of this tape. It's a really magnificent tape. It's a shitstorm for the bears, is what we keep saying, which is if you're looking at the wrong things, you're getting the wrong signal. This is a much deeper market than Web 2. But at the same time, Facebook continues to execute, right? So it's really just a fascinating deep market. Phil, we want to get it back to JC on
JC Constellation Energy chart, fresh monthly candle at an all-time high. It's such a beast. My God. What
do they do?
What's not to like here, JC?
Yeah, listen, it's a utility stock. Utilities are the leaders this year. It's more about being at the right place at the right time. Utilities can be leaders in a bull market. They were a leader in that 04, 05, 06, 07 bull market. Go to the quarterly returns. So you have utilities up almost 20% in Q3 alone. And some people are like, well, it's a defensive rotation. It's not good when utilities are leading. That just simply is not true. The data doesn't suggest that utilities leading is bad at all. If anything, it might be more of like an interest rate thing or anything or something like that. But if it was just utilities, that would be one thing. But when you have consumer discretionary, industrials, and financials all up double digits in Q3, it's hard to convince me that this is a defensive rotation. Consumer discretionary, financials, and industrials doubling the returns of the averages and leading the way throughout Q3 is by definition the exact opposite of defensive rotation. But I did want to ask Jeff, since we have you here, Jeff, I have been noticing a divergence in the RCI hospitality. If you could show up that slide 23, I don't know if you've been doing any channel checks on RCI, but when I see one going higher, kind of like a Dow theory divergence between RCI and stocks in general more broadly, you could use like a value line. Geometric index is really good with this. Any thoughts here, or don't worry about it?
I wouldn't worry about it yet. It's keep an eye on it for sure. Again, I think it's all speaks to just normalizing behaviors. I think we're just as a nation just trying to kind of refigure out how we're going to spend our time, how we're going to spend our money, and you're going to see a lot of spread in terms of what do we do? Went out and bought all the crap in the world. Everyone redid their house. Then everyone traveled for 3 years. No one bought new clothes apparently for the last 4 years. I think we're all just kind of seeing that balance in terms of, if it's RCI hospitality, I'm not following directly. I'm not that worried about it. I'm just trying to kind of follow the flows of where the crowds are going right now.
It's a money spending thing. Are people spending money or not?
We're all just
kind
kind of seeing that,
right? Are people being aggressive?
Right.
Are they aggressively spending money irresponsibly, right? And I feel like this group of companies is a great irresponsible way to spend money. So it's historically been a good measure for me for the consumer discretionary space, but broadening strength of the market overall. So it stands out.
It does. I mean, it for sure stands out. But it's something to keep an eye on. I don't think it's gone yellow light just yet, but maybe flashing green, maybe kind of
buyers
definitely keep an eye on it. What's that?
Buyers better step up soon. It's now or never with these guys.
Yeah. They're going to be sorry later. I mean, it's and you also have a nice stop point. I mean, you look at that Home Depot chart. That's you've got defined risk sitting right there. It's going to break higher or it's not. We get to see how real the move is pretty fast.
It's a good buy.
JC, tour us quickly before you go around the rest of what looks interesting: transport, metals.
Let's just go through those charts quickly. The Nasdaq 100 just closed at a new all-time high. The S&P 500 also just closed the month at a new all-time high. The Dow Jones Industrial Average new all-time high. New York Stock Exchange Composite, New York Stock Exchange Advanced Decline Lines. These are all making new all-time highs. These are things you see in uptrends overall. even transport. So speaking of the Rick's Cabaret divergence, the transports divergence is something that's been, to me, been front and center. Is this a divergence, or is it just that the transports haven't broken out yet? Here are transports making new 12-month highs. So that's not a bad thing. That's certainly a start. And even in Europe, right? Euro Stoxx 600. This is the S&P 1500 of Europe, making new all-time highs. Notice the composition. You don't have the technology exposure there. Technology has been a big loser in 2024, underperformer for most of the year, particularly small cap tech, which I also showed. So Europe's strength here, the fact that it's got a lot of healthcare, a lot of industrials, a lot of banks, more so than technology. The lack of technology is what held it back for 20 years while the US was up and to the right. And now Europe's lack of technology, from what we're seeing here, is part of the reason why it's doing so well. Even areas that you have bad news, look at Tel Aviv. The Tel Aviv Exchange Index just made new all-time highs. The ETF continues to make new highs as well. But if you want to just finish up with that technology chart, that's slide 31, that's the big one. In 2023, you had large cap technology continuing to outperform into the end of the year, despite small cap tech already rolling over. And then throughout 2024, small cap tech has continued to disappoint, and large cap tech has had its struggles as well. Just an underperforming sector. And by the way, this gets back to sector rotation being the lifeblood of a bull market. When you hear that, like, what does that mean? That sector rotation, what does it mean? This is what that means. This is that. You're seeing it, right? This is that. Technology was flat in Q3, flat. Discretionary, financials, industrials, all up double digits. That's sector rotation.
Love that. Howie, how much do you love that candle on the Tel Aviv Stock Exchange? It's an all-time high candle. And meanwhile, they're bombing everybody.
It's a tale of two stories, right? The story is the will of the people, the such a tiny nation with so democratic nation, whether you love or hate the leadership, proving again in a democratic society the way you invest money in tech and people pays in life. But at the same time, we got to understand the drag on Israel that's ahead, which is eventual post-war, right? The PTSD, the et cetera. So it's a market that I'm rooting for, but a market that I'm wary of because I speak to the people behind the stocks. And remember, it's fun to talk about stocks because that's our job here at Trends with Friends. But people work at these companies, and the amount of PTSD and misallocation of human resources because of terrorism and what's going on it makes it hard for me to even look at that, because it really is such a great chart because it explains the difference between price and how you feel about things, right? Like which is just one of the most incredible charts that Tel Aviv can be doing this in a world where Europe can't get its act together around anything, right? From policy to tech to nuclear to anything. Right. Now, of course, they have incredible.
Yeah, but the stock market in Europe is making new all-time highs.
Yeah, but in a completely different way, right? Low tech, but in a completely different way. Low tech is all I'm saying. All right, so I think that's it. What do we got? Riley with trend with no friend.
I just had one. I just had one quick had one quick behavioral comment about that. What's going on in Israel? My take on it is, and I could be wrong. But my take is that they fundamentally changed the political dynamic in the Middle East over the last 7 days. And we are now within a week of the first anniversary of October 7th. And what you saw them do, just dismantle Hamas, Hezbollah, Houthi, all extensions of Iran, that there is a huge positive risk that Iran is a paper tiger and that they've exposed them and that they have more coming, and that the fundamental dynamic in that region of the world will change potentially for the better. And we're not seeing that on the news, but maybe we're seeing some of that in price on the Tel Aviv Stock Exchange in that monthly candle. Okay, let's move on. Trends with no friends. Riley Roseby, you showed up. I love it every single time. We have a great one here. JC loves the mid cap industrials.
How can you not?
What's
I
your-
like things that go up. What's wrong with that?
You like things that go
Rick's
up.
Cabaret, baby.
This is a
That
name
one's
that's
not going up,
that's
but
for
I see what
sure.
you did there.
This
Riley, take it.
is a name that's definitely going up. So today we're looking at Acuity Brands. If we want to pop up that daily chart there, Acuity is a $9 billion industrial lighting and building management solutions provider with about 1,100 followers on StockTwits. So I took a screenshot of this chart this morning. The stock gapped up. It's up about 7% after reporting earnings this morning. And this gap here may be the catalyst that really leads it to the next leg higher. Let's go ahead and zoom out to the monthly chart, though, because I think that tells the big story here. And Acuity is emerging out of this massive 8-year base. So as long as we're above about 280, which was its former all-time highs in 2016, it seems like the path of least resistance is going higher here. So
one more, the beauty. One more that like goes.
Yowza.
The peace trend. Look at Otis Elevators. I don't know if we can quickly pull it up. Otis, which was also on Trends with No Friends. There could not be more a brand that stands for rebuilding or growth, but boring growth than Otis Elevators. That is the brand used synonymous with buildings. And Phil, if you said if peace is a thing that no one's factored in, well, we're soon to find out if you're right. And nothing stands for rebuilding all the damage and growth in Otis Elevators, which I think is at all-time highs. Nobody talks about it. It was on the Trends with No Friends list. So much like Acuity Brands, there is a lot of stuff going on underneath the surface that, much like Mike, you were saying that like Camco and all these uranium stocks were going up for a year before policy started to change. A lot of these industrial, not just kind of data center industrial, but now with rates coming down. I mean, look at this chart, right? It's like an incredible. Is this Otis Elevator?
yeah.
Yeah. I mean, this is an insane, breakout in a great company that, I imagine they get 80% of the building, business for build out. So a lot of buildings need to be rebuilt. Any infrastructure, if that's coming with lower interest rates. So these are the type of companies that no one's looking at that are kind of worth finding by reverse engineering social.
And Otis is just crazy. That's a great dig because, man, that ties into nothing you would hear anywhere. I mean, CRE is a disaster. There's not a single thing you put an elevator in that anyone's bullish about. And yet there's Otis, man. Look at Otis. He loves us. I mean, it's just breaking out. It's doing what it's doing.
It's a $40 billion
Otis, my
company.
man.
Otis, my man.
Otis, my man.
You
So
should be leaving. What a good idea.
So anyways, the story,
Exactly.
listen, again, my catalyst there is not well thought out, but again, when stocks show up on our Trends with No Friends list, we like positive trends that have nobody talking about them, especially, and because eventually they do talk about them. And with companies like Otis, it'll be at $140 before someone talks about it. If this trend is for real, that breakout looks real, all the storytelling that I'm doing around this is made up, but possible, based on the stuff that Phil's saying, based on just this is how the markets work, right? People start snooping around, and hedge fund analysts are pulling up tickers all day, sending it to their boss, going, maybe this is a play on that. They make a few calls. By the time you hear about it, the stock's 140. So that's kind of what we're doing on Trends with No Friends, I think, in short order. All right, I think I got a hop. Phil, what do we got? Anything left?
Oh, okay, if we got a hop, we got a hop. I was going to say, we've only covered like half of our stuff for today. You had that Degen economy index that you're crushing it in. You blogged about it today. We got a chart in there if you want to just give me a minute on
pull
that.
it up quickly. I'll because this goes to all of us, right? Put this together in May of last year. The idea is, much like my 8 to 80 portfolio and kind of the Vice portfolio of old, The vices have evolved, right? Like we talked about, from it's not just sugar and Coca-Cola anymore, although I think Coke is breaking out. We've got vaping, we've got gambling, we've got zero dated options. This index, if you pull up the components behind it, is not really a YOLO index. It's the companies that power the YOLO economy, right? CBOE, ICE, CME. They're the Visa and MasterCards of this. The Apple, which and Google, which supply the interface to this. There's the DraftKings and Flutter Entertainment. There's Bitcoin. There's Coinbase. There's Robinhood. There's 100 or so companies. What I worry about right now, and I wrote about today, is the degenerate economy too big to fail? Because you won't read a positive story about gambling. I don't gamble, so I have no problem with it, but there is no positive stories that gambling will bring. There are no positive stories about vaping and Philip Morris. There is some hope around Ozempic and stuff, but if you look at my portfolio, I'm trying to stay away from the true degeneracy, right? The front end of degeneracy, the addiction part of degeneracy. These are the companies that power degeneracy. But I do worry with the China importing vapes. I do worry with guns in our schools, and I do worry about just how we talk to each other. That degeneracy is kind of a little bit off the rails. But this is how I play it. I'm going to continue to evolve it, and it's just going to be a constant discussion for us over the next 10 years.
And Howard, from my AI filter point of view, at least half of those names are AI driven,
Yes.
not just the apples.
And
I would put
say
Van
that-
Eck in there, etc.
Yeah, it's a
I just
picks
want
and
to highlight that.
shovels version of degeneracy. Like when I say degeneracy, it's not GameStop and meme coins, right? That's cultural. But there are companies that are printing money. So, for example, I have Axon in there because it's tasers and cameras.
Totally.
Right?
No, data.
Degeneracy-
That one, Axon
data.
has data, which is extraordinary.
It's the most incredible company. They have this unique monopoly on crime data and police data, and it's going to be one of the larger companies in the world.
And I would highlight Roblox there, because
I just added it.
It's awesome because of the gaming companies, they're on the front of applying AI versus Activision and all the other game studios, etc. For most of those other guys, it's a cost mitigation lever. For Roblox, it's a growth lever. And
Roblox has spent about 4 years since its IPO digesting gains in its market cap. And if you talk to any 10-year-old that's into gaming, that is where they live. That is their Snapchat. If you're not using Snapchat, you're using that, or you're using both. And so exactly like you said with AI, and it's just a little bit more positive form of degeneracy. It's
a hugely positive form because it's creativity. This young generation, because what they're learning with these tools is how to use their voice and texting and to create things. They happen to be virtual, but they get energy and creativity and learning out of that. So everything to me is a positive and a negative. And the positive here is the kids are learning with tools to how to create things for themselves that then lead them to other things. And so it's a great starting point. And so Roblox has to execute, but it's a great platform, just like Minecraft, which is Microsoft.
Yeah, it's just like Trends with No Friends. We're trying to, and what I'm doing with the degeneracy index, right? There is this thing with HODL and Bitcoin and YOLO. They're right, but they're wrong in how they're delivering the message, right? It's funny, but YOLO is powered by very profitable companies, right? And they miss the messaging. These kids are, like I said, they've adapted Robinhood, which I'm so excited about, and Coinbase, but they're not using it properly. They're not adding KoiFin or FinChat or all the other products around it to be the connoisseurs or the aficionado of this business. The next layer of learning to invest is actually building it as a language that you can, like JC does. Like JC's a master, right? You can learn two things. You can be a sommelier and be a sommelier of the markets. Like there's two ways. There's sommeliers of many.
My wife says I just like taking tests. That's what she says.
So I love the fact that young people, and I just like to add one more. I think one of the trends I do like over the last couple of years is young people and older people are learning Howard, you talk about it all the time, have learned how to figure out diversification. ETFs have really come into their own. The best chart I saw on StockTwits this week was that $10 trillion ETF asset chart that they put up. And it's a great milestone to keep in mind that the mainstream has figured out that there is an easier way to access all this stuff that we're talking about. And yes, there's a role for active and passive. And if people on this call, we're going to be in the active side of it, just because this is what we do. But for most people, this is the way to build compounded wealth over the long term. Whether it's
but much like Walgreens and drugstores, which are failing, ETFs are the beginning of the beginning, because at many levels,
Totally.
they're hurting the market, right? They can't buy IPOs, which is a structural problem in the market, right? So
great
mutual
point.
funds, the 90s, you could Garrett Von Wagner and all these guys, they were getting access to IPOs. Now that was too much of one thing. We've gone too far the other thing. With how many trillion in ETFs, guess what we're suffering? There's no new issues, right? Now, I'm not saying no, but not a healthy amount of new issues.
Great
right?
point, and that's a topic for another call. The reason for the dearth of IPOs is structural changes on the private company side.
Yeah.
Because the growth in the secondary markets and global capital flows from everybody who wants to invest
But it's also on the structural side at the distribution end, which is these ETFs
totally.
for 6 months can't buy IPOs.
No, I got that part.
Yeah.
You're totally right. I agree.
Problems.
I agree with that. But look, if we had bought or a fund had bought Amazon at the depths of Amazon.bomb in 2002, when it was down 98% as a public company,
you could have got it for $6.
And you could have done the same thing in 2008, and you could have done that same thing in about 5 years
Here's the
later.
easiest way to own those. Let's be honest. This is why truly index investing works, and this is why Phil is correct. The only way to have held Amazon was to have indexed Amazon, right? So, it's like that Seinfeld thing. You know how to take the reservation. You just don't
balls. You need balls of
You got to
steel.
hold the reservation.
You need
You
to.
gotta
You needed to
hold the
forget about it entirely. You needed to put it into an account that you lost the password for, and you forgot you even had the app. That's the only way you're holding that thing from 100 to $5.
But
No, that's the only way I benefited. Go ahead.
I couldn't hold Lilly unless I have held it in ETF, because I couldn't have predicted it being an $800 billion company because of one drug. I mean, Eli Lilly is now Intel. I was at a movie theater and Eli Lilly is doing Eli Lilly brand ads. Like, people are not noticing that company's not going away. Like, they're tripling down on Ozempic and their brand. So they are the new Intel of Intel Inside, right? Like, that blew me away. It was a very contemporary ad about Eli Lilly, which masked their one drug, Ozempic, which should have just been showing people shrinking. But anyways, we live in this incredible, complex. We just lost Phil. So, all right, we're gonna cut it off and bring it up next week, everybody. Mackey, we'll see you at the event in a couple of weeks.
Excellent. Looking forward to it.
All right, everybody. Thanks,
Great.
everybody.
Thank you. Thank you again, Jeff. It was nice to see you.
Thanks.